All right. Thanks so much, everyone, for coming here. I'm not going to be selling, Bastion on stage. The goal is really establishing today kind of like the list of challenges that are ahead of us as part of building a stablecoin payment ecosystem. I'm going to be defining what are the entities that are part of the ecosystem. I'm going to go through the main challenges and what we see as kind of the main ways to really, get past those, mitigate essentially those risks, and really opening the doors to create really the future of money with programmable money. So let's start with setting the baseline. Something that I think I'm hearing very often, especially at conferences, is the fact that people are pushing for decentralization and self-sovereignty and a lot of things. And the reality is that the vast majority of the people or the businesses really just don't care about it. They care about having money that is accessible, that just works, that is cheap to transfer, that allows them to connect very broadly with people and other businesses. And that's what we should be focusing on. And I think that so long as we start from this principle, a lot of roadblocks will actually be a lot easier to get past, whether that's on the regulatory side, on the banking relationships, and many other integrations, throughout kind of all the things that stablecoin touches as part of the ecosystem. So let's kick it up with just kind of like setting the baseline in terms of the evolution, I would say, of money. Money supply has really evolved over time, starting with just paper money and coins, and especially held by banking institutions, then evolved, and we call it M0. It's the most liquid form of money. Then evolved towards M1, sometimes referred to as narrow money. So it's a little bit less liquid, but still pretty liquid, including deposits held at banks and including kind of like commercial banks, not just central banks and others. And then M2 is kind of an expansion around that, then includes less liquid money, and that includes saving accounts, short-term deposits, and retail money market funds. And what we're seeing is that there's a huge demand, essentially, to have the structure of the global money supply to evolve and to include actually different types of assets that can actually be structured as collateral or backing for money so that it can be transferred faster and cheaper around the world, and having the type of interactions that you can have with the money really be programmable for different use cases, right? And this is why I think everyone is so excited about the future of stablecoins, is that it doesn't really need to replace a lot of the things that are out there. It just needs to improve them, to make them more modular, and to make them more programmable. We just kind of like providing some context on Bastion. So we are a regulated wallet infrastructure provider, and a lot of our customers are actually companies that build stablecoin related use cases, really moving money, whether that's domestically or globally, for faster and cheaper than the alternative rails. And the three things I would say that we see the most focus on and the most work on is first, B2B payments and remittances. So really just replacing very expensive and slow money corridors, whether that's from business to business or whether that's from person to person. Separately, we see a lot of businesses that are actually pretty excited about increasing the types of assets that they accept as forms of payment. We actually saw earlier today Louisiana being the first state in the US accepting crypto as a way for people resident in Louisiana to pay for government services in stablecoins, which is extremely encouraging for us, I would say. But yeah, so checkout and payment acceptance from merchants, and we're seeing a lot of increase around that, very excited. And then finally, global payroll providers. Not sure if anyone here has been using Deal or Deal for just an example. but they're seeing an immense amount of growth just because they support businesses to hire globally, right? Whether that's for contractors, whether that's for employees. And payroll is actually extremely expensive to do globally. And there's a lot of interest for much cheaper, essentially money movements around those salaries for contractors and employees globally, so that the employee can actually has an additional, 3%, 4%, sometimes 5% globally. So those are kind of like the three things that we see the most worked on, but it is extremely hard. And part of it is due to the size of the touch points, the amount of touch points that stablecoins have. So everything that you see here is actually not even an exhaustive list. There are actually a lot more entities, parties that are actually working to make stablecoins payments work. Some more than others. You may notice, central banks that might not see always kind of like stablecoins in the best regard, but all of them are included as part of this effort, whether it's parties that are actively working on, or that we are helping understand the value and include essentially processes and laws and regulations, and sometimes it goes as low level as having accounting teams and accounting firms that can actually support businesses who want to accept crypto, who might have to pay taxes on stablecoins. So you can see essentially that it ranges from infrastructure providers, lawmakers, the issuers, might be the on and off ramps, that might be the companies that provide ledgering as a service off-chain. There's obviously on-chain infrastructure. A lot of different partners, working together to make this a reality. And at the core of it, stablecoin payments, really fall into two buckets. The first one is, let's call it wallet to wallet, crypto to crypto. So wallet on one end, sending to wallet on the other end. Wallets on both sides can be institutional, they can be custodial for retail, they can be custodial for businesses, they can be self-custodial as well. There's a pretty broad range, obviously, of types of wallets, and we're seeing it kind of like expand over time. Something that is also obviously pretty relevant is getting fiat into stablecoins and getting stablecoins into fiat, right? Commonly called on-ramp and off-ramping. And the sources or the destinations on the fiat side are actually pretty broad, right? Different types of banks and banking partners. That can be also different types of cards. We are seeing a lot of evolution towards prepaid cards as well, not just credit and debit. And so that's something that can increase in complexity, but at the end of the day, really falls into these two buckets. So let's dive. In order to understand a little bit more about the challenges that we face, it's pretty important to understand the anatomy of these two flows. Focusing on the first one. So you would have a person or a business that would be leveraging either directly or via a service provider. As I mentioned, a self-custodial wallet, an institutional custodian wallet, or an embedded wallet that is kind of sometimes referred to as wallet as a service. And then same thing on the other side, whether as a recipient or as a sender. On the other side, the way fiat to crypto and crypto to fiat works is more complex, right? So we have a person and a business, or a person or a business that want to essentially send to potentially themselves or someone else, person or business. And on the crypto side, obviously it's kind of the same setup. There's still someone that has a wallet and that will interface with the on-ramping provider. The on-ramp will have its own wallet, interact essentially with exchanges and stablecoins that can either provide liquidity and convert back and forth, or mint and redeem. And on the fiat side, the on-ramp provider will actually have a banking partner. And the way this relationship is actually set up, or at least in the US, is called an FBO account, for benefits of. The on-ramp will actually have a special type of account that is actually used, dedicated essentially for the holding assets on behalf of other businesses, on behalf of other people. This is required to actually separate and silo the assets of the users of the service and the assets of the on-ramp provider, the own company, right? And that is oftentimes required for regulatory reasons and protection of customers. And the on-ramp is generally facing some type of fintech, some type of bank, and sending essentially those assets, whether that's through ACH, SEPA, SWIFT, and so on, and potentially also having those assets sent to a credit card or a debit card owner. So now that we've mapped this out, we need to generally understand, why is it so hard to build? Why aren't we seeing more growth? Why are we seeing on-ramping and off-ramping that is still so expensive? And the reality is that, just for the wallet-to-wallet flow, which is a lot simpler, there are a lot of things to take into account. The first one is UX. I believe that the speaker right before me was also building, just like us, a wallet solution that need to take into account UX, right? You need to make it, you really want to make wallets feel like the modern internet. I don't think that anyone likes to click a bunch of different pop-ups and see different gas fees and data essentially that might be associated to more complex systems, right, than my family member would be used to. So we think about UX first. Second, we think about security. Obviously, everyone wants to be safe. No one wants to have to think about whether their money is still going to be there tomorrow. And then finally, regulatory compliance, right? That generally doesn't apply to the self-custodial wallets, but definitely does apply to embedded wallet solution and institutional custodian. And so in this setup, the part that is actually pretty important is having a path to be regulated as an institution. And we can see that in the case of on and off ramps, it's actually much worse. You can see that all the parties essentially that are part of the flow, both on the fiat side and on the crypto side, are actually all regulated. They all need money transmitter licensing. They need banking licensing that might require broker-dealer licensing and all forms of trading activity licenses to be able essentially to support this type of flow. And obviously, the bank being at the core of it. So we can see that there's a lot of complexity across the board, both from a security standpoint and a regulatory compliance standpoint. Very hard to get access to FBO accounts, which I'm going to touch it in a second. And it actually goes very, very deep. And there are a lot of issues that are happening right now that very few people are aware of. The first one is that regulations are extremely complex and fragmented. Like I just show here 4 different ones, whether that's Europe, US, Singapore, Japan, with 4 different, completely different frameworks, all different, right? So if you want to be, just like us, a regulated wallet provider, you need to go talk to every single one of these regulators. Even in the US, you have to register with every 50 state regulators independently. Very complex. Secondly, there is something that is actually happening in the banking as a service, nothing to do with crypto, just on the fiat side, that is extremely impactful and will redefine how fintechs actually interact with banks. When I mention FBO accounts, this setup is changing dramatically. And today, only one US bank actually accepts to onboard fintechs for FBO accounts. It's extremely hard, essentially, to onboard. Third, we're seeing essentially a lot of complexity around yield-bearing stablecoins as securities. The problem here is that yield-bearing stablecoins have a tremendous amount of, create a tremendous amount of incentives for businesses who want to, receive yield on all the stablecoins that they hold, right? To share a little bit of the money that the reserve holder might make. But obviously, it is deemed a security, at least in the US and under the EU rules. And so both of them are actually making it illegal for the vast majority of typical regulated wallets to hold those assets. Generally in the US, you need a completely different type of licensing, whether that's a bank charter or whether that's a broker-dealer license, which is extremely hard. And everyone knows that the SEC is pretty complex to work with these days on the crypto side. So Last slide, just wanted to go over what I think, and what I see as kind of like a path forward to tackle those three things. The first one is, let's start small. Let's start small, let's get adoption, prove value, essentially, to a lot of these businesses, really show that we are reducing the fees for massive transactions globally, and then use that as a proof point to have larger companies leverage stablecoins. We're seeing that with PayPal, we're seeing that with Stripe, we're seeing that with many other companies. Second, we want to make sure that we focus, and as I mentioned, starting small, we want to be very focused on the global corridors that are actually the most expensive and the slowest, right? This is where we will bring the most value, and we're seeing that mostly between US and LATAM, US and the EU, and US and Africa. Tremendous amount of B2B activity, tremendous amount of P2P activity, and there's a huge market need for it. So let's focus on that, and let's have proof points. And finally, let's ensure that we have regulatory compliance to increase the comfort from regulators and banking partners. It's extremely important. FTX, unfortunately, and Prime Trust have hurt the industry tremendously, and now regulators and banking partners, we actually are going over a lot of the due diligence, with some of the regulators. It's extremely hard, and it takes, sometimes 3, 4, 5 months of due diligence from those parties. So really, I think that if we have, those three things are the most important for us to remember. Start small, let's get adoption, let's focus on where we bring the most value, and third, let's build a safe ecosystem that will make regulators and banking partners more comfortable so that we can be more connected to the fiat ecosystem. Thank you so much, everyone.